Here we go. Okay, recording. It is May 15th. No, May 16th review session, accounting 201. All right. So the question is, how do you distinguish between perpetual and periodic? Is that your question, Talia?
Yeah.
Okay.
Or like ways to remember how to record perpetual inventory system transactions.
Mm-hmm. And I think it has a lot to do with really wrapping your head around the flow of inventory, you know, and it's also has a lot to do with when you go and name a store that you guys shop in. Just throw out the name of a store.
Target.
Target. Rowan, what's another store?
Zara. I spend too much there.
Zara and Target. Okay, so if you go to either one of those stores, you'll either get an email receipt or whatever, and it'll show you what you bought there. You know, if you're at Target, maybe you bought shampoo, the receipts are quite detailed these days. And that is because Target and probably Zara are using a perpetual inventory system because they're tracking their inventory that's coming in, that's being delivered to the Target, and then at the cash register, they track the inventory that's going out. So at any given point in time, the computer will tell you how many items do we have of this particular item. This sweater, size 7, navy blue. It's very specific. In retail, we call that an SKU. Do you guys know that? Have you heard that before?
Yeah.
Trivia question, do you know what it stands for?
No, but I just see it everywhere.
Yeah. So people will say, oh, go count the SKUs. And what it means is, let's say there's a SKU associated with my sweater, and it's very, very specific. It's going to say it's a navy blue sweater. It's a size 7 or 6 or small or medium, but it's only going to have a unique SKU. You could have what looks like the identical sweater, but because it's a different size, it will have a different SKU number. So it stands for stock keeping unit. And so with the perpetual system, they're tracking items down to the SKU. So they know how many size 7 navy blue sweaters of this style, how many size 8s or 9s or 10s. It's very specific. And so retail has wanted that forever. So when and they all started converting around the 90s to this perpetual system, cost a lot of money because before they didn't know what was on the floor, what was available to be sold, except by counting it manually. Okay. So the perpetual system is just the accounting for a company that does this system. So what they're saying is, and let's just take a quick look at those journal entries. And find them first. And he will be okay. So let's just start out with the PowerPoints real quick. So when we buy inventory, we say we're increasing, and again, this is all perpetual. When we buy inventory, let's say we bought, and I even came up with, this is called an invoice. The company, Jennifer's Office Supply, is buying inventory. Calculators, 2 different kinds of calculators for $1,400. We immediately put that cost in inventory. And this is the first chapter you've had inventory. Okay. And then there's accounts payable because we're going to pay in 30 days. And then we say who pays the freight, and depending on whether it's FOB shipping point or FOB destination, it's either the buyer or the seller. Well, if it's shipping point, it means the buyer owns it at the shipping point. So the buyer has to pay the freight. So again, we debit inventory. We don't debit freight. Okay, that's different with perpetual. Okay. If the seller paid the freight, that would be the journal entry. Then the buyer sends some of the product back and says, hey, these were defective, or these are the wrong color or whatever. And so we reduce the inventory. So we credit inventory and we reduce accounts payable with a debit. And then finally, the buyer pays the bill. And you can see accounts payable, we owe $12.70, but the buyer isn't paying $12.70, they're paying 98%. Why? Because on this bill, if we go all the way back to the invoice, whoops, the terms are 210 net 30. And what that means is you get a 2% discount if you pay in 30 days. Otherwise, you pay the whole thing in 30 days. All right, so here we are paying our bill. I'm going to move forward here. So the cash is only 98%. We got that little discount. All right. If the buyer could not afford to pay the bill early, you debit accounts payable and credit cash. Okay. All right, so those are the basic purchasing transactions. Now we're going to flip it and say, what if we're the seller? And again, we're doing a perpetual system. So in chapters 2 and chapter 3, you sold something, you debited accounts receivable, you credited service revenue. But in chapter 5, we're saying we didn't sell service, we sell product. So we're debiting accounts receivable, crediting sales. You could also call it sales revenue or just sales. But now it's a 4-line journal entry: debit cost of goods sold, credit inventory. So what are we accomplishing here? We're recognizing the cost of the inventory we sold to Jennifer's office supplies. Of course, the cost is lower. How do you come up with the cost amount? The problem has to tell you. So here it says, assume the cost was 75% of sales. Okay. Could you figure out the cost if I told you, assume the gross margin is 25%? The answer is yes. If the gross margin is 25%, you know the cost is 75%. Okay. All right, so then we do the return, and we always put the inventory back for the return. And again, it's 75%. And finally, we recognize that the customer paid us, but again, it's at that lower amount because the customer took the discount. All right, so that's just a quick review of perpetual. So now let's move on to, now, before we move to periodic, how are you guys with the multi-step income statement?
I think for me, the multi-step income statement was the easier part compared to perpetual and periodic journal entries, just because we've already had some experience with income statement.
Okay,
it's just
good.
a lot of listing, you know.
Yeah. Talia, you're a little bit muffly. I don't know if your face is away from your microphone or it's just a bad connection. I don't know.
Can you hear me better now?
Say something else.
Multi-step income statements were better than perpetual and periodic just because we've had more experience with income statements.
Got it. Okay.
Yeah.
So we start with big sales and then we subtract sales returns and allowances. The only thing I'm going to tell you guys on the multi-step is you'll have returns and allowances and discounts for sales, but you'll also have them in periodic for purchases. So make sure you keep them separate. But this is for perpetual. So it's real easy. We have cost of goods sold. It's just one line, and we calculate gross margin. We calculate net sales. And we add up all the operating expenses. So you just need to know what's an operating expenses and what is not an operating expense. Okay. So we're going to come down here. So there's operating income or income from operations. And then here we have the non-operating gains, revenue or gains, and expenses or losses. So interest revenue, interest expense are not operating expenses. And gains and losses, any type of gain and loss, are not operating expenses. So they go below the subtotal. You add the revenue and gains, you subtract the expenses and losses, you get a net of 700 because the gains were more and you're going to add it. So you got 20278 and 20978. And then income tax expense, the problem has to tell you what it is. Is it 20%? Is it 30%? And then you calculate net income by subtracting income tax expense. Okay. So know how to make one of these. We don't do single steps, so just a comparison. All right, so periodic is easier in some ways and harder in some ways. So a periodic system would be more like a small store that can't afford tracking their inventory all the time. They have to do a count. Maybe they do it once a month. If they don't count their inventory, they don't know what cost of goods sold is. So you have to count regularly. Okay. All right. So the sales transaction, the first two lines are the same, but because we're not perpetually tracking inventory, we don't do that second set of journal entries. Okay. Because the periodic means cost of goods sold is only recorded periodically. We don't record it at the point of sale because we don't know what it is. If I'm doing a perpetual system, I know exactly what I sold. And so it just goes in automatically. That's going to be true for the returns as also. We know how to do the sales return and accounts receivable part of the transaction, but we're going to record inventory coming back. Okay. And then this journal entry for recording the sale is the same. Okay. Okay, so now let's look at, yeah, so this is what I want you to look at. And you have 5 things here. I'm not hung up on all these subtotals, okay? The goal is to figure out how to calculate cost of goods sold. So if you were to take a great big box and you were to say, beginning inventory, purchases, that's 2. Less purchase returns and allowances, that's 3. Less purchase discounts, that's 4. Plus freight in, that's 5. So 5 things, starting with beginning inventory, equals goods available for sale. Okay. In this case, it's 154,050. Okay, those 5 things. Then you run out to the floor, you take a physical inventory, and you say, this is our ending inventory. You subtract it from goods available for sale, and you get cost of goods sold. Okay. So this system works great for a small environment where you just don't have the time or computer software to track every sales cost. Okay. So you just do it periodically. And you do it by adding up those 5 things and getting this really important subtotal, goods available for sale. All right, thanks for one. So, and then you subtract ending inventory. All right. So how do you keep them straight? So one of them tracks cost of goods sold perpetually. One of them tracks cost of goods sold periodically. Okay. So with the periodic inventory system, we only use certain 4 accounts. And let's go back here. These are the new accounts: purchases, purchase returns and allowances, purchase discounts, and freight in. For perpetual, we just use inventory for that. Okay. All right. So when we purchase something, and those 4 accounts are temporary accounts. We close them down at the end of the year after we take physical inventory. So here it is: debit purchases, credit accounts payable, debit freight in, credit cash, debit accounts payable, credit purchase returns and allowances. And then finally, when we make the payment, purchase discounts. Okay. And you can see them here again. All right. Now, at the end of a period, we say, these are our balances in all these accounts, okay? But remember from the previous slide, we took inventory and it was 11,850. That's a physical inventory where you're walking out on the floor and you're physically counting, okay? So we know that our ending inventory in our T account has to be 11,850. We also know, because we calculated it, the cost of goods sold is 142,200. So we've got to empty out purchases, purchase returns and allowances, purchase discounts, and freight in. So purchases is a debit balance, purchase returns and allowance is a credit balance, purchase discounts is a credit balance, and freight in is a debit balance. So we're going to build a journal entry where we empty those accounts out and we adjust and we book the whole 142,200 to cost of goods sold. And then this 850 here for inventory is how we get inventory to equal out what we physically counted. 11,850. Remember on the previous slide, beginning inventory before the adjustment is 11,000. And we want it to be 11,850. So we're going to debit it. And there's a really cool slide in the back of your, it's on my PowerPoint slides, but it's also in the back of the chapter. And it just does a side-by-side comparison, Talia. I don't know if you saw that in the book. If I were you, I would print those pages out if you can get access to a printer. Okay. Showing perpetual and periodic side by side. And then this is the type of transaction, a purchase for perpetual, a purchase for periodic. And those green accounts are the temporary accounts only used for periodic.
Okay.
And then
That's
here's
helpful.
the
Thank
sale,
you.
and here's the sales transactions side by side. So you can see for sales, it's kind of easier. For purchases, you can see it's brand new accounts. Accounts payable is the same though, and cash is the same. But
You
you
said
can
it
see
was in your PowerPoint and in the textbook.
it is, yeah. And then
I'll have
you
to take moments, so I missed that part.
okay. You can see here that the journal entries are identical for sales. You just omit the cost of goods sold transactions. Okay.
So for periodic inventory system, they don't track COGS because it's at the end of the accounting period, right?
Right. They don't really have a way to do it. They don't, I mean, you could, so like think about going to the grocery store and how they run the barcode over the reader. At that moment, they're deducting that item from the Safeway store or the Target store inventory. They're saying, oh, this is the cost of the item. We're down one sweater, size 7. I don't even know if they make size 7, but anyway, we're deducting one sweater, size 6 from the this Target store. Okay. But on a periodic system, no, they cannot do that. They have to do they say, oh, we sold it. We can see that we sold it, but we don't have barcoding. We just ring up the price. We know what it was sold, but the person at the cash register is like, I don't know what the cost is. So you have to go back and just make a big bucket of cost and then do an ending inventory and subtract it. And then here's another practice one if you want to practice, and then the solutions are in the back. Okay. So, hope that helps.
Yeah, what the slide is on right now is very helpful. I'll